If you think you can only afford a single family home because of how expensive real estate is, think again. I am so excited because today I'm going to be talking about a very exciting opportunity for rookie real estate investors. You can purchase a multifamily home with just 3.5% down using an FHA loan. I'm Hannah Escher. I'm a mortgage advisor and rookie investor with 2 properties, and I am thrilled to be speaking with you about this topic today. First off, what is an FHA loan exactly? Well, an FHA loan, or Federal Housing Administration loan, is a loan backed by the Federal Housing Administration, which is a government agency within the U.S. Department of Housing and Urban Development. FHA loans usually offer more lenient credit score requirements. They offer a low down payment option, and usually they even have more leniency when it comes to debt to income ratio. So sometimes your debt to income ratio can even be higher than what you're looking at with a conventional loan or USDA loan, let's say. For more information about an FHA loan specifically, go watch my video that is all about FHA loans, and that will explain everything you need to know about getting started with that type of loan. Now, let's talk about how an FHA loan works with a multifamily property. So an FHA loan is going to be the same thing where it's backed by the Federal Housing Administration. However, it allows you to purchase a property of 1 to 4 units instead of just a single family home. The reason we're looking at 1 to 4 units is because usually once you get outside of that 4-unit mark, you're going to be looking at commercial properties. So the Federal Housing Administration specifically allows the purchase of a 1 to 4 unit residential property with the requirement that the property is owner occupied. So that means in order to use that very low down payment of 3.5% down, one of those units has to be owner occupied. Now, buying a multifamily home can be a very strategic move as a new investor. One, because it allows you to buy a much more expensive property without having to use all of your own qualifying income, and also being able to get into that property with a very little cash investment. One of the biggest perks about purchasing a multifamily property is that you can use the rents from those units. Let's say you're occupying 1 unit and you have 3 other units available. You can use future rents from those 3 other units to help boost your qualifying income. Now, when we're looking at qualifying for this type of loan, there are going to be specific metrics that have to be met. So you're still going to have to qualify to make those monthly payments. The lender still needs to see that you can afford that monthly payment. And that's where using these future rents comes in. Most of the time, it's very important to remember this. You're not going to be able to use 100% of that rental income in your qualifying income. The reason being those are usually future rents. So most of the time your lender is going to take 75% of that future rental income and be able to add that number to your qualifying income. That's something really important to remember if you're trying to do the math yourself on figuring out if these types of properties are going to work for your situation. Again, I would always recommend speaking with a mortgage advisor and getting those solid numbers in place before you really go out and look for something. But if you're just in the preliminary stages of your planning and setting goals and seeing what's possible, it's important to remember that 75% rule, just so then you're not getting into a situation that you can't afford. So let's talk about the requirements for FHA loans. As I mentioned before, they usually have more lenient credit requirements. So you can actually go as low as a 580 credit score with an FHA loan. I do want to say that if that is where your credit score is, your debt to income ratio usually has to be lower than what it could be otherwise, and you may not have as many options available to you. There are some lenders that are going to do what's called an overlay, which means they have their own set of rules that will have to be met aside from the FHA's rules. So in my experience, even though FHA allows a 580 credit score, you're really going to want to be looking at a credit score that's over 600, preferably 640 or higher. Once you're at that 620 to 640 mark or a little bit above that, then usually you're going to have all the options available to you. I say that because if the credit score is lower, then your debt to income ratio is going to be lower. This can make a really big difference. With a lower credit score, you might be looking at a cutoff of debt to income ratio of around 43%. If your credit score is a little bit higher, if you can get over that 640 mark, then you might be able to go up to 55% debt to income ratio. That is a major difference. That is huge. So as you're looking at this product and the possibility of using it in the future, remember that your credit score is still important. It doesn't need to be where it would for a conventional loan or conventional financing, but you still want it to be in a spot where you can take advantage of all the other great things about this FHA product. And one of those things being a higher debt to income ratio if your credit score is in the right spot. FHA loans for multifamily homes are very versatile. So again, you can use them for a 1 to 4 unit multifamily property. So you can be looking at a duplex, you can be looking at triplexes, fourplexes, or anything in between within that combination. Now, another important aspect to think about when you're looking at these properties is you want to look at the zoning. So just because something looks like 2 units or 3 units doesn't necessarily mean it's going to be a multifamily property. If a unit is a multifamily unit, it will be zoned multifamily. If it's not, it's going to be zoned single family. And the biggest difference there is with a single family unit, let's say, there's an ADU, or let's say there's a studio in the back, or something of that nature that looks like it could be more than 1 unit. You're going to have a more difficult time using rental income from those other units if it's a single family home and if it's zoned as single family. If it's zoned as multifamily, then you're going to be able to use the rents from those additional units in your qualifying income. So it is important to check that property zoning, ask your realtor about that. If you're looking into using this type of loan, make sure they know that the properties have to be zoned multifamily. Now, with that being said, there's definitely new rules and regulations that are going to be forthcoming in the future that will allow more financing on ADUs and other units on single family homes. However, not everyone is allowing that yet. So I would still recommend, if you're looking to use this type of loan, really try to find those properties that are multifamily zoned, so then you know that the financing will be available on that property type. Another quick tip when you're thinking about using this product is be aware that if the units you are looking to purchase are already rented, you're going to have to use the current rents from those units in your qualifying income. Many times when a property is already rented and a new buyer is looking to purchase that property, many times those rents are going to be under market rent. So just make sure you're aware of that when you're looking at these properties. If it's already occupied, if you're going to keep those renters in the unit for your qualifying purposes, you're going to have to use the current rents. If the units are empty, then you have more of an opportunity to use higher rent numbers in your qualifying numbers. So again, just know what you need for your situation, know where those numbers hit for you, and that's going to help you be able to shop better as you're looking at using this loan product or looking at purchasing a multifamily property. I recently covered how you can use a 5% down conventional loan to purchase a multifamily property. So how do you choose which is the right one for you? Well, let's talk about it a little bit. And if you want to watch that video, you can find it in the show notes. So just as a reminder, when you're looking at a conventional loan, that type of loan is not backed by the federal government. That's offered by banks, by credit unions, by private lenders, and usually it has a higher down payment requirement than an FHA loan. In this case, it's not much higher, but it is 5% down versus that 3.5% down. So already off the bat, if you're tight on cash, then an FHA loan might be the one for you. Next, let's talk about mortgage insurance. Both of these products are going to have mortgage insurance if you're coming in with a low down payment. Now, one of the biggest differences with an FHA loan is that mortgage insurance does last usually for the life of the loan. And that's a big difference when it comes to FHA versus conventional. With a conventional loan, at that 5% down mark, you are going to have mortgage insurance. However, if your credit score is high in the high 700s or 750 plus, that mortgage insurance is going to be quite affordable. And it will fall off once you reach that 20% equity mark. So when we're looking at the mortgage insurance, the conventional sometimes wins out. And then if you're going conventional and you're putting 20% down or more, you don't have to have mortgage insurance. Now, something I will say about FHA mortgage insurance is that recently that insurance was actually reduced. So FHA mortgage insurance has become more affordable over the past year or so. And that makes that monthly payment much lower. And the nice thing about FHA financing is that the mortgage insurance is not tied to your credit score. So if your credit score is lower, your mortgage insurance is still going to be affordable. Versus in a conventional loan, if your credit score is lower, that's when that mortgage insurance number can really tick up. So one of the biggest factors when you're looking at deciding to use an FHA loan or a conventional loan should be that credit score and those credit metrics. And usually if your credit score is lower, the FHA loan is going to be more affordable. And usually if your credit score is higher, the conventional loan is going to be more affordable long term. Make sure you're taking a look at that and considering both those options in relation to where your credit score is right now. Another difference between conventional loans and FHA loans is the type of property. So conventional loans, because they're not backed by the federal government, you have a wider array of properties that you will be able to lend on and get that loan on. FHA does have stricter requirements around the type of property. Something else to consider when you're thinking about an FHA loan versus a conventional loan is that debt to income ratio. Now, with conventional loans, the cutoff really is that 50% mark. And not all lenders are going to let you get to that 50% mark because maybe they have overlays themselves. However, with an FHA loan, you can go up to that 55% mark if the other factors in your profile allow it. So if you're looking at trying to qualify for a higher amount and you're just not getting there with the conventional financing, maybe try switching it to FHA to see if that gives you a little bit more qualifying room. Now, you definitely want to be speaking with your mortgage advisor when it comes to hitting those higher debt to income ratio marks. There are many things that have to come into play in order to allow those aspects to be approved. And I would suggest that whether you're going conventional or FHA. If you're really thinking you're going to be in that higher debt to income ratio area, whether that means you're closer to the 50% mark with conventional or closer to the 55% mark with FHA, make sure you're being very clear with your mortgage advisor about what's possible, what your numbers need to look like, and what is going to be allowable. So FHA can definitely be the winner on that mark, depending on your situation. Another thing to consider is the total cost over the life of the loan. For example, FHA usually has lower rates. However, you are going to have that mortgage insurance most of the time for the life of that loan. The way you can get out of that is refinancing into a conventional loan. If you refinance into an FHA loan, though, you're still going to have that mortgage insurance. Now, with the conventional loan, a lot of times the interest rate is going to be slightly higher. However, you're not having to keep that mortgage insurance forever, and the mortgage insurance payment might be lower than what you could get going FHA depending on your credit score. So make sure you're looking at the long-term costs of these loans when you're evaluating what product might be the one for you. Another good tip when you're considering long-term costs is make sure you have an idea of when you think you'll refinance. Because if you're going to refinance very quickly, If your plan is to do that in 2 to 3 years after you get into this loan, then the long-term costs, they're not going to be that big of a deal. You're not going to be in that loan long-term. It's more important to think of those long-term costs when you know you're not going to be refinancing out of that loan anytime soon. If you are going to be refinancing in the near future, then it's more important to look at the upfront costs, because those upfront costs are usually not going to come back to you if you refinance soon. That is something to consider if you're thinking that you're going to get out of this loan sooner rather than later. Look at, okay, well, how much is this whole process costing me upfront? And will it be worth it for me to refinance into a new loan in a short period of time? Choosing between a conventional loan and an FHA loan, going multifamily with 3.5% down versus 5% down, really comes down to your goals. So make sure you're speaking with your real estate professionals and make sure you're doing all the research to determine which of these is going to fit your situation best and help you get to your long-term investing goals the soonest. If you feel like using a calculator would help you in this analysis of determining whether to use an FHA loan or conventional loan and getting to look at the different costs, you can become a pro member of BiggerPockets and have unlimited access to all of our calculators plus a bunch more items. But you can go to BiggerPockets/pro now to get access to those calculators and help you in this analysis to determine whether an FHA loan at 3.5% down or a conventional loan at 5% down might be the better choice for you. All right, there you have it. Now you know that it's possible to buy a multifamily home with 3.5% down using an FHA loan. If you have questions about this, please drop them in the comments below. We would absolutely love to hear from you. And also check out all of the other videos we have going on about loan products, how to be a landlord, and how to get started investing in your first property. Thank you so much for your time. I'm Hannah Escher. You can search my name at BiggerPockets. If you found this video helpful, like and subscribe to the BiggerPockets Rookie channel for more videos just like this.